But so the logic for this trade, I think you kind of see it, right? It would be just purely based on this channel. What I believe has been a clear historic, again, knowing this thing is super volatile, it's been a clear historic recent history respect for this channel. I'm just looking for more points down there. No, those are the points. I'm going to leave that chart where it was so those circles make sense. So unlike, and I want to point this out because this could scale where other people can use this. So unlike this this purple line that has been breached, quite a bit, this is actually out of 1, 2, 3, 4 measurements of, was this respected or was it not within obvious proximity, like to where it could be considered respect. It's 4 out of 4, I mean,
Hmm.
that's pretty amazing considering the bodies of candles on, you know, 4 different occasions went through it, and there's numerous wicks that went through it. 4 out of 4 is a much better degree of respect. Just kind of like taking the time to assess these little nuances, really. So that's all the logic and why that trade setup looks good. So then I just have to ask myself, if I found something that looks pretty good, this is what we call a setup for anybody watching. And I go, the setup looks good. Let's just say the conditions look good. And then let's just say the asymmetry is acceptable based on the setup that I see. Well, then the other part of it that I would look at would be, now, what do I do with the math? I'm going to see if Zoom has better text features or trading view. I think Zoom might, but so the question would be, I haven't used this yet, but I think the question right here would be, so what do I do with 2.42%? If I know that that's my stop loss, then what do I do? Am I comfortable losing 2.42%? Some people would just say yes, but the question should be 2.42% of what? And so then I start plugging in numbers, and I think this is where kind of like the algebra comes in. If I'm just doing spot, let's just say I'm just doing spot, I could say something like 10,000, and this is just regular, no leverage, like 1x, so to speak. So 10,000 is kind of like what I'm thinking about. I'm just kind of at least just running numbers on. And I would say like PYTH may not be something you'd put that much money into. We'd have to really check the liquidity and all kinds of things. You don't want to be like the whale of of it, but there's a lot of liquidity on a lot of these. So we'll just pretend, right? 10,000, again, just kind of like spot, no leverage, 1x trade. And then so if it's 10,000, then I start running numbers, right? So if I put in 10,000, then that would mean that it would be 10,000 times 1.1283. So I would be risking 10,000, or not really risking 10,000, but I'd be using 10,000 to make a profit of 1,283, not counting slippage or fees, right? This could be obviously different if we really tried to count for slippage and fees. So 10,000 would be the proposed, by my own mind, position size with little to no leverage. And then that would mean that the math on this other part of it needs to be figured out too, right? So if we're looking at that, then it would be 10,000 times, let's just say it's 2.5 for easy math. So times 0.975. So about $250. Probably didn't need a calculator for that. So now on an organic trade, if I have $10,000, and not everybody does, but if I'm a trader with $10,000, I could ask myself, now I have the education to ask myself, do I feel comfortable with this setup, putting in $10,000, knowing that my risk will be $250, knowing that my reward will be $1,283 profit? knowing that this is so far a 4 out of 4 respect of that line probability setup. And in this case, knowing that I actually found a way to create 4 layers, we'll say 3 layers of confluence, right? I have a pressure, or I have a channel that literally lines up with the volatility cloud for the 2 hour. I have a pressure line. I have another pressure line, 2 pressure lines, and I have the channel, right? So you have literally 3 pressure lines, which are very much smaller time frames. I think they're like 3-day pressure lines. But I see they kind of work, right? Because I see one right here that works. I see one here that works. I see like body candle respect here that works. So that's like a nice little added layer. I see it worked right here. And so now I have two little backup pressure lines. I have this one that has been respected numerous times. In fact, every single time it's been respected. It's kind of amazing, right? 1, 2, 3, 4. This wick went a little low, but in that case, these pressure lines were respected. So to me, if I'm a patient trader, then this trade is a very high probability long. I like the asymmetry. I like the reasoning. I feel like I have more of a chance of being successful than not. And so if I can make, 1283 at the risk of 250, not like a lottery ticket where it's like a 1 in some crazy chance of winning, but more like my statistical probability is actually strong in my favor, then I would say, yes, I'm interested in doing this. And so then all a person has to do when it comes to leverage, which most people don't do. I mean, you can imagine nobody does this stuff before they actually go into, 20x trades. But all a person really has to do is say, now, if that's the case with $10,000, do I want to make that, do I want to magnify that? And so the game of magnification, if you had 10,000 real dollars, would be, do I want to 2x this? If I 2x this, I'm still at a 5% loss, which isn't terrible. So now this number goes from the 250 to 500, right? So now my risk is I'm playing a game, and it's just what game a person wants to play, but I'm playing a game now where if I play it at a higher level, I'm risking a bit more. But if I'm going to double the risk on loss, I also want to be, respectful of the fact that my gain would now be 25.66. And so that'd be plus. That did not work the way I planned.
I haven't used that feature on Zoom either.
Oh, you know what? I bet I could just erase it. Trying to figure that out. Okay. Yeah. So now it would be plus, what did I say? 25.66. So this is kind of like why people with more capital tend to be in a position to probably capitalize on a bit lower risk, right? Liquidation comes into play with people who are, especially on PYTH, like at 5x, if you're not conscious of it, liquidation could easily come into play. As far as like maybe just for instance, if PYTH goes to here or here, at 10 or 15x, or even 5x, like liquidation is a threat. When you are at 2x on any given asset, liquidation is like usually, I'm just gonna totally make this up, but like let's just, I'm gonna get rid of all this stuff. When you do that, just for instance, liquidation is usually like way far off the radar. It's like way down here or something.
Mm.
Might even be further away. I don't know, but people should always look at where liquidation is. But I can promise this: 2x liquidation zone, even if I'm just making this up, is probably like way down here compared
Right.
to somebody that's like doing a 15x on PYTH, and it's like let's just pretend liquidation zone is like way up here. It's like way closer to your price action. And liquidation is relevant because if it happens to go there, it can remove all of your capital from your position and just take all your money. And so that's, never a desired
with
result by anybody.
some fees on top, right?
Yeah, yeah. So, so it's in fact, Joel kind of pointed out that like if I don't know, let's say the position is going against you and you're riding it out, you can always add more margin and probably protect yourself. But if you're right here and maybe your price action is right here and it just seems to be like expanding lower, you will actually save money by just selling out here versus getting liquidated.
Hmm.
Like pretty significant money relative to the trade. So that's just kind of another random FYI. But with all that being said, the other thing that comes into play with all of I think the average person is okay. I don't have $10,000. So how do I trade the position sizes of that person? That those examples were made of, right? The guy that's going after 25, 66, and he's willing to risk, 500. And so, without going too into it on the details, you can basically do backwards math and then find a leverage that would allow you to do that, right? So I could literally do 1,000 and I could trade it at 10x, or I could do 2K and I could trade it at, 10x. And you'll have the same exact potential outcomes, right? You could even have your stop loss and lose 500. You could have your take profits and set yourself up to make 2566. You could do it with $1,000 instead of actually these numbers are for the 2K magnified, not the one. But you could kind of like get these results with that leverage. But I think that the closer you are to using more capital and less leverage, the more you will be likely to statistically win. The wider you'll be able to set your stop loss zone and still have the asymmetry that you want. So in other words, just kind of like putting this another way, 5K at 4x leverage is just mathematically, I don't know how to say that, but just or what I would write, but safer, not safe, not to be misconstrued with 100% safe, but 5K at a 4x leverage is mathematically and statistically and relative to liquidation and threat of liquidation and money velocity statistically safer than 1K. Of course, this is with the stop loss, but then 1K at 20x, right? To get that 20K result. And when I say unsafe, assuming they both have stop losses of, something like this, you can't get the same asymmetry out of this one. To keep your losses mitigated, you have to have a much tighter stop loss. And that is basically why people lose, right? They cannot do this because if the 1K person does it at 20x, then that
Yeah,
means this wide of a stop loss would cause them to lose 50%, if I'm not mistaken. So 2.42 times 10 is 24. So times 20 is 50%, right? About. So that's why the person operating and playing the game of 1,000 at 20x, stands to lose 500, lose half of their money relatively quickly. And the person at 4K, also stands to lose, but money velocity is different and asymmetry is different and the absolute values are different. So playing with the larger capital and only, like a smaller movement is better. And I wouldn't even play this particular one at 4x, unless I was willing to lose 10% of that 5,000, right? Because you have to magnify the losses. But doing it with even lower capital at even lower position sizes, even safer, because you can withstand the downside, and I think it's more palatable to handle the downside of these moves moving against you. But it also has to just be a number that your money psychology, how your comfort level with money and what it is to lose it and what it is to make it, allows you to handle. And I think that for most people, the threshold should be when it causes emotional, when it causes you to be like emotional and stressed and have tons of anxiety, you're probably just playing with too much money or too much leverage or both. So it should be a number that causes your emotions, little to no movement. And that's probably, way more ideal.